Good evening and a warm welcome to you and your money. I'm Bryan Hurst. This evening we're focusing on the investment world. Since Liberation Day on 2nd of April, markets have consistently reached new highs. However, these returns have largely been driven by global trends, particularly the strong performance of major tech companies. In South Africa, gains have been concentrated in PG and PGM counters, as well as process and NASPAs, which have carried much of the market strength, supported by a robust gold price. Our market's rises had little to do with the local economy. If these key performers are stripped out, the overall picture looks far less impressive. And joining me this evening from the Zoom room is Cape Town, is Henry Biddlecombe, CEO of AG Capital. Henry, just let me remind you, for 2 years while COVID was on, I ran this program from my home. And it's hard to believe what happened with COVID. And here you are again on my line from Cape Town on the Zoom room. So good to have you on the program with me, Henry. Henry, you've been waiting for something to bring down our market, as so many commentators have said. Last week's report on Aston Martin's results, Aston Martin, and then the weakness on Ferrari. Is this an indication of what one can expect from other companies who are going to be reporting in the next 2 to 4 weeks? Is this something that you've been waiting for? And how do you think other companies are going to come out with reports over the next few weeks? Because this is the first time they're really going to be reporting on following the tariffs.
Yeah, well, let's look at Ferrari as an example, Bryan, because I think that's a nice bellwether stock. So it's not that the results were bad, it's that the market had lofty expectations and their forward guidance just didn't match those expectations. And I think that's probably a kind of an indicator of the backdrop that we have in the market at the moment. I was looking this morning, consensus is that the S&P 500 group of companies will grow their earnings at 16% next year. And those, given everything that's going on with the tariffs, given what's happening in the employment numbers, I think that those are fairly lofty expectations. So if companies do disappoint, and given where valuations are at the moment, you could see negative reactions in their stocks.
Henry, you've been waiting for something. I mean, no one knows what it's going to be. I mean, we saw on Thursday, we saw Trump announce further tariffs on China. We saw the market down on Friday. We saw the rand move from around about the 1710 mark quickly to 1750. And then we see it recover slightly this morning to 1730. So any indications what you're waiting for? By the way, I was absolutely a bit mad that Trump's a bit disillusional, because if you think about it, he's done a phenomenal job in trying to bring peace to the Middle East. He's there now. I was watching on TV him arriving. I think we can be, if anything, he's done anything that we can really tick and say, well done, Trump, that's it. And then he goes and does something so stupid. How do you see this playing out, this story about extra tariffs? And you talked about companies coming out with 16% increase in earnings next year. If this does happen and the market's satisfied, but you've been saying for a long time now, this market is overpriced.
Yeah, look, I mean, let's just look back to the beginning of the year when the S&P was shooting towards 6,000 points. And nothing could go wrong. Then all of a sudden, tariffs hit the tape in March and April, and the market corrected all the way back down to 4,800. Since then, the end outcome was a lot less severe than people feared, and so the market's resumed its rally, and we sit at 6,700 odd today. But again, valuations are back. In fact, they're beyond where they were at the beginning of the year. So it goes back to my original point, Bryan. There's very little margin for error in valuations at this point. So whatever the shock may be, and it's always difficult to predict what it will be, you can expect that the reaction by the market will be outsized and probably to the downside.
And extreme. I mean, we saw Ferrari, I think, down 15%.
Yes, and given where it was, it's still quite an expensive stock.
Yeah.
And the market's expensive.
Henry, any earnings expected this week? Anything that you can comment on?
Yeah, so we're approaching earnings season. We aren't nearly in the thick of it yet, but over the next 2 weeks, I think the picture will become a lot more evident. We're watching employment numbers coming out of the US very carefully. you are seeing some early indications of softness there. What you really need to pay attention to are the revisions that will start to come out, because ultimately that gives you a clearer picture of what's going on the ground. And corporate earnings tend to follow that data.
Henry, just give an indication to our viewers, why are we so focused on what happens in American markets? I mean, we talk about when America, sneezes, the whole world catches a cold. But why are we so focused? I mean, does whatever happens in the American market have a major impact across the world?
Yeah, well, just look at the numbers. I mean, America still constitutes 25% of global GDP. The next closest nation is China at 15 and Germany at 5. So it's by far the biggest influencer of the global economy. And more than that, it's a consumer-led economy. 70% of America is driven by consumption expenditure. And those are companies that we're all connected with. The world's a much smaller place today. So we all watch America. And factually, Bryan, especially as South Africans, we're all mostly invested in America, aren't we?
Yeah. Henry, a major announcement on the 26th of October regarding whether South Africa will be removed from the grey list. What is your view on this, and what do you think the implications will be, both if we are removed or we not removed and we remain on the list?
Yeah, look, I think if we aren't removed, it's going to be more of the same. If we are removed, it's fantastic. I think you'll see a little bit of a positive reaction in the market. It'll be fantastic for businesses that are involved in international trade. It's going to remove a lot of the friction that we're dealing with at the moment. So, yeah, an incremental positive if we're removed.
Yeah, Henry, let's just talk about it, because there were 22 things that needed to be done to get us removed. 20 were a lot easier, administration and structures and compliance. The two I just don't understand is the one was corruption and the other is money laundering. And I think there's a good feeling we are going to be removed. But then have we pulled the wool over the eyes of the different bodies that make this decision? Because what have we done when it comes to corruption and money laundering and all the things that go with that?
Yeah, I mean, without commenting too much on what's going on in the news, I mean, you're seeing a lot of unearthing happening, which is positive. But what you really want to see is follow through, prosecutions taking place. And historically, we don't have a very good track record in that regard. So one hopes that you'll see a pickup on that level over the next 6 to 12 months, because there's plenty to pursue, it seems.
Okay, then Henry, let's talk about what's been in the press recently. Firstly, that South Africa's relationship with the United States is improving. However, there's been little mention of AGOA. How important is this agreement, and what impact does it have on our relationship with the USA if it doesn't improve? And what do you think? Do you think it is improving?
No, I think it's worsening. AGOA in and of itself is not overly important to the economy. It's 2 to 3% of exports, but it is important to the automotive sector and the agricultural sector. I think it's more of a sentiment issue, really, where, it's a forward indicator of where US-South African relations are going. But at the moment, they're very, very strained. So AGOA is certainly at risk.
And the latest comments about SWIFT, and what does that mean? The probability of South Africa now losing access to the SWIFT payment system.
Yeah, I don't think we'll lose access to SWIFT as a country. It's very possible, though, that there will be targeted sanctions, so perhaps targeted at certain political parties or even key individuals within those parties. I mean, that's probably where you'll see preventative measures first. There'd be way too much collateral damage for South Africa if they were to sanction us as a country or to, cut us off from SWIFT. So I think there's a very remote possibility of that happening.
Yeah. And then, as I mentioned earlier, when America sneezes, the whole world catches a cold. While the US dollar appears vulnerable due to the country's high debt levels and a government shutdown now entering its 11th day, do you anticipate any significant move away from the dollar? And at the same time, most of the major global tech companies are listed in the USA, are unlikely to change their listings. What are your thoughts?
No, look, I think this shutdown has become a little bit of a clown show, to be honest. Both sides use it as a pressure tactic every year in the US now, and I don't think anyone takes it overly seriously. I think if you remember when the first one happened, it had an impact on the market. But it's a little bit like the boy cried wolf now. The boy who cried wolf now. So I don't think you'll see kind of a move away from the dollar or big globals reconsidering where their listings sit simply because of that.
So you talk about softer US labor market data. Why is this positive development, and could it lead to further interest rate cuts?
Yeah, so a softer dollar, it's really a function of, I guess, the massive increase in the money supply in America over the last couple of years. And the result, so you've had the debasement trade, and then obviously with softer employment data, the US are cutting rates, which has meant that the carry trades are now starting to unwind. So we're at that point in the cycle now where you will see dollar softness.
Are you expecting interest rates still to be cut this year?
In America?
Yeah.
Yeah, so I think you will see further cuts.
Yeah, I've got an
Perhaps
email
not this year, but early next year.
I've got an email we'll deal with about South African interest rates. And then Henry, I noticed the numbers being spent on AI, and the numbers I read, and I just read them. So I always warn people that what are you reading? Who's the author? But it said in 2022, $74 billion was spent on AI. And this last 12 months, 451 billion. I can't confirm those numbers because I just picked them up from an article. But companies are unlikely to be seeing significant profits yet. How is this likely to impact in the short term on those companies that are spending such large amounts which can't yet translate into profits on the bottom line?
Yeah, Bryan, I mean, this is the $1 million question at the moment in markets. I mean, those are the stocks that have driven the market upward. The Mag 7 now constitute, 40% of the S&P 500?
Yeah.
And these are businesses which 2 years ago were capital-light models generating a huge amount of cash and earning a very high return on invested capital. Fast forward to today, and these companies are now as capital-intensive as a mining business. You look at Meta. There's a business which a year ago had $30 billion of free cash on its balance sheet. Today, it's got nothing. So if you go and work out the revenue that these companies need to generate to earn a reasonable return on invested capital, let's say 20%, you reverse out a revenue number of $400 to $500 billion. Now, consider that Microsoft's annual revenue is $280 billion, Alphabet's $350 billion. You're talking about needing to create a whole new Microsoft or Alphabet just to justify the capex that's been spent in 1 year. And I think it's a huge risk to markets at this point.
It must be, Henry. Well, we're going to take a short break. Stay tuned, and we'll be right back.